So we'll wait for 1 more minute and then we'll start. Let people join. I think they will
Yeah,
have.
yeah. How things going on?
Doing good, sir. You're
Yeah.
looking vibrant today. So yeah, Friday evening, lot of things. I think we should start. I think we respect the time and wrap up on time. Meanwhile, people can join. We got good registrations, but I could see like still people are coming up anyways.
Okay.
So thank you, Manish, for coming for today's session, and it's always great to interact with you during good times about startup and everything.
Yeah, yeah.
And
Always,
this gives
always.
me opportunity to introduce you as well out here. And for your information, we are also live on YouTube, and we'll keep it this video for the repository for coming time, and your startup can go and have a look into this.
Okay.
So, so introducing you, Manish, is a accomplished professional with extensive experience in serving clients both nationally and internationally. He is currently holding the position of co-founder and director of Alpha Value Consulting Private Limited, a company specialized in transaction and fund advisory services. With more than 18 years of expertise in the valuation and transaction advisory domain, Mr. Srivastav has previously worked a renowned organization, including PwC, Stock Holding Corporation, City Financials, and a Cat 1 merchant banker prior to establish his own firm. Additionally, he is a chartered member of TI and an angel investor for his network, Alpha Value Venture, as well as various other startups he is associated with. Beyond his corporate engagements, Mr. Srivastava is a frequent speaker at leading business schools such as ISB, IMs, and a lot of other good B schools that he is interacting with. Along with that, actively mentoring for Niti Aayog and Atal Incubation Centers throughout the country. So thank you, Manish, for accepting our invitation and to be part of this session. And I hope the audience out here would get a lot of insights from your knowledge and your experience.
Yeah,
Thank you. Over to you, sir.
thanks for introduction. And really for me to be with you. And in the today's session, the playbook that being defined, like we need to talk about the term sheet, which being a very critical element
Absolutely.
whenever you look or go about for funding side, as well as we with regard to the valuation. Like everybody talks about what is the value of your company is. So how to go about how to find the ballpark number. And this is something, it may be people say art, science, or whatsoever it may be. And so when you talk about valuation per se, I would say it's being more than a science. And a lot of people have now defined it. It's neither being an art nor a science, but it's an craft. So
Okay.
as on date, suppose you start your business, and lot of the time there being a confusion in the mind of the person, like the day one will be the one on which the company got incorporated. Okay, but there may be a scenario or the situation, like I may have started doing something, some innovative thing. Maybe I invested 2 years into it. Okay, but now I feel that okay, this is the time now I can build a business on it, around it. So then I go at incorporating a company. Okay, so it is not like when you say like incorporating a company, it's a day one. But I would say, like with regard to the startup, when you started thinking about what is the idea that you are thinking about it, building a business around it, uh, finding the gap that exists, what you want to serve, who is going to be a customer. So all these things that start. So this is, so most of the time, like when you talk about a company like deep tech, they may be like he has gone into like may have invested 1.5 years, and then they go for the incorporation of the company. Okay, so important aspect is, like, suppose one says two companies are starting on the same day, means incorporated on the same day. But like, what is the homework the person has done? So if suppose somebody is saying that I will incorporate a company and then I will start doing something, Another person saying that I already done most of the thing and now. So there is a difference in the value proposition the two companies hold. Maybe both have the same date of incorporation, but the value that they hold is different. Okay. So the important aspect, because when you say startup valuation, I've been talking at a very pre-early stage startup, because this session is for the incubation side. Okay. So very pre-early stage, when you say that may or may not be the company has a revenue. I've been building something where I reached to a TRL, suppose TRL 4 or 5 or 6, but still there's no revenue. So is there no value to me? No, it's zero revenue means no value. So, or is there some value? So there's a lot of confusion in the mind of people. People say there is a fair valuation. There's no concept, I would say, of fair valuation. It is just a practice that being followed. When we say writing the report for the regulatory perspective, we say that this is the fair valuation. But the question is like how the valuation being built. Valuation is built on the premise that certain set of investors coming together thinking the possibility of making the money by investing into the company, so that at a certain period of time they can get a good exit out of it. So this is basically a notional value which being framed together, because when you say like zero revenue but showing the projection and saying the value of the company is 10 crores or 20 crores, it means like there's a possibility of the things. There's a market that being there, there's a scalability, there's an opportunity, and this opportunity people want to encash it. So this is, they feel that okay, 10 CR is a good value to make an entry point. So everything is dependent upon when you are making the entry and when you are making an exit. So the entire game is entry and exit. The investor looks at what is the entry point and when I will get an exit point. Okay. So this is a basic crux. So now defining like what, from the investor perspective, I will talk first. What is the investor looking at? So investor are not just looking at your number. They say that, okay, TAM, SAM, and SOM, you run the slide and the pitch deck. They know everything, SAM, TAM, and what is the number going to be. But the question is, what is the process that you are following? What is the technology behind it? Who are the people behind it? Okay. So these are the certain factors which look into building the value for the company. If I say somebody who has worked with a company like Adobe for about 15-20 years, he knows the in and out of the segment and the industry, and now he's starting something where he's finding the gap. So here I would say that he has a value and he can build it around it. So it all depends upon the technology, the team, what is the gap, what is the market size. So once all these things being looked at, the investor defines his scorecard, and based on the scorecard they say that okay, what is the viability of this business, whether it will be good, bad, a good investment opportunity or not. Okay. So this is called the scorecard methodology. I will come to it. Let me open the slide, let me share, that will be helpful. So can you see the slide, the Burkus method?
Yes, I can
So
see.
they are being like when we say like how it all started, when it all started in the Silicon Valley. The PayPal was the company when like they thought about like okay, to build something in the payment system and the payment gateway, and that is how the entire like ecosystem of the startup got started. And so few things that at very early stage people felt about it, what need to be looked at. So that is called the very first method called the Burkus method, which talks about there need to be a sound idea, there need to be a proof of concept and prototype for that, there need to be a strong management team who is, or the leadership team, I would say, I would not say management team, but a strong leadership team, and as well as what is the product that you are rolling out, and what is the sales, when the sales will come. Okay. And what sort of the strategic relationship that you hold. So these are the certain key parameters that have been defined, and then they say that based upon this, a certain weight need to be assigned. If you have a sound idea, your value need to be $0.5 million. If you have a prototype ready, it may be again $0.5 million. So that is a scorecard. So this is a very basic initial scorecard that been built. And then post this, the number of factors start being placing by the investors. And now they look into like somewhat close to 30-35 parameters to judge whether this will be workable, not workable, whether what the opportunity that you're talking about, whether that will actually work or not. Okay. So it's not like just about, a lot of people think about like valuation is going with a discounted free cash flow methodology. That is something, a magical methodology that you run the numbers, you get anything, whatever you want, you get it. So, but this is the most sensitive model. I would say DCF is not a right methodology in order to get the valuation of any company. The most important is what is the impact that your company is going to create, what is the market size, what are the number that you are throwing based upon it, and who are the competitors in your market, who are the competitors, and when your competitor have raised the money, what is the value at that which they raise the money, what is the revenue at that point of time, not today. Your competitor may have moved from series seed to series A to series B, and you are saying that my value should be the same. It should not be. So it all depends upon what is the stage that you are. A lot of people feel about that valuation is an art or a science and can be and a valuer can come and value anything. A valuer cannot value anything, I would say. It is the investor which values anything, because now from the I being into valuation from the last 18 years, now I being more into the investment side. So I would say valuer to backward calculation करके वो value बताता है जो which the investor wishes and places the value. Okay. So so when I say valuation, valuer can do valuation of any tangible, intangible, but cannot do valuation of anything which is of archaeological importance, maybe like a beautiful, magnificent Taj Mahal, or no valuer can come and value it, because there can be a buyer to it, but there is no seller to it. Okay. This is one of the prime method, and I will not go in detail, but this is the method which generally being followed to look at what is the projection going to be. I say, okay, what is the market size? Okay, what is the revenue number you're going to strike? For achieving those number, both ballpark numbers, what you're going to do? Which of the cities you are launching your product? Okay, what is the per unit price of your product is? Okay, so these metrics being built and the model being defined, what is the capex that being required in your business model. Okay, and so once that being run, this model being run, so then we try to sanitize it and look at like, okay, what should be the probable value of it. Okay, and then we build scenario analysis and say that this is the most optimistic, because every promoter, what he says in a very optimistic, he would say I have done it a very conservative approach, but at the end of the day, whatever you say, the investor will look at and say, okay, 50% is the value, we are slashing it, because that is something what may or may not be achieved. So that is a scenario based analysis that need to be looked at in order to value. So there may be an optimistic, there may be pessimistic scenario, and there may be the most likely scenario, and based upon that the value need to be looked at. Okay. Then another important method, which is called the venture capital method. This is a method which generally a venture capitalist uses in order to find it out. Like suppose if I invest this much of quantum of money into the company, what stake should I hold into the company? What is the dilution that will happen, and what is the stake I will hold into the company? So just an example, that a broad example, like how it need to be done. So suppose there's an investor and he's thinking about that, okay, I will place $1 million into your company, your startup. And he has an expectation. So these are all talk is about expectation. So here's an expectation that 25% is the IRR, internal rate of return, what he will command. And then he says that, okay, I will not talk anything. At least 5 years a tenure, I will stay invested into a company. And as on date of investment, the revenue was suppose $0.5 million. And he's saying that year 5 net income need to be what the founder is saying is $1.5 million, though we will able to achieve it. And he's saying that I want at least like 10x as a P exit multiple. So this is all the framework that he has already in mind before investing into a company. Because why so he has in mind, he has all these things in mind because there are so many opportunities, there are so many asset class. Why should you go and invest into such a risky stock maybe like an early stage startup? He would say that there are a lot of things available. I will go and invest into the Sensex. I will go and invest into the real estate. So there is always being a risk and the reward game. So that is the trade-off that happens between the risk and reward. So now, if you look into this, like how it being computed, required future value of investment is $1 million he's invested. That is investment amount into 1 plus 25% is the return he's expecting. Power 5 means 5 year over a period of 5 years. It is coming $3.05 million. Now, at that point, the company is expected to be worth how much? The exit value of the company equals to, he has defined it already, that is $1.5 million into 10 times of it, that is $15 million. So hence the VC must own how much is 3.05 divided by 15, that is 20.3. So he said that with $1 million investment, I want to command 20.3% stake into your company. So this is the rough calculation that goes into while making investment into, or what is the stake I should take by investing a certain amount into your company. Okay. Now there are certain key VC metrics which uh, uh, investor looks at while investing into it. So one is like he will ask what is the MRR and what is the ARR rate, means monthly recurring revenue and annual recurring revenue. I will just place a line to it which will be helpful to understand. Suppose if a company make the very first transaction, it is called a sale. If he makes the repeated second transaction to the same customer, then it will be a trust. And if we keep on doing the multiple times, the same customer keep on purchasing it, then it is called the loyalty. Okay. So nobody is interested to look at if one person come to your platform just for once. They want to see the repeated sales. Somebody may land at your particular portal or anybody and make a sale and then find that the product is not very worth, the product is not good. Maybe you made a very flimsy way and you say that okay, this is such a good product, but then purchase, but after using it not liking it. So monthly recurring revenue and annual recurring revenue, these are two important things that the investor want to look at. Then the average contract value, what is the minimum contract value that been there? Suppose you go and say, what is Zomato, we want to order some food. So they say that minimum order will be this much, so then the delivery charge will be free. So they don't want to provide you like 10 rupees, 20 rupees or 50 rupees order. They want to like make it at least some minimum contract value, maybe 300 rupees, 500 rupees, something like that, so that will be helpful to bring the unit matrix or the unit economics into the picture. Okay. Then another important aspect is the CAC. What is the customer acquisition cost? And that is something very relevant because when you being new into the market, you cannot go and make any customer until and unless you spend something for the customer. Okay. So that is called the customer acquisition cost. Suppose there may be a dairy product company and they're saying that you purchase 2 packets of milk, you will get 2 packets of milk free at the very initial phase when you are subscribing it. And that is what it is, the customer acquisition cost that will be there. Okay. So if the customer acquisition cost is heavy, it means that it is like at the bottom line, it is hitting it, and then it is impacting your profitability. So you need to be very cautious about like what is the customer acquisition cost, what is the medium that you should use for making the customer acquisition cost. Then what is the churn, that how many people coming and then how many people are going away. That is another important aspect. Then contribution, this is very relevant point. Contribution margins, sales minus variable cost. If suppose you're not able to cover your variable cost, your business cannot run because you'll become the monster of losses. Just keep on looking at the revenue. And if suppose you're not able to bring at least the viability to your variable, I'm not talking about fixed cost. Fixed cost may come later, but suppose the variable cost also you're not able to cover, then there's a question mark on the viability of the business model. Okay, so at least like you're able to have a certain positive contribution margin. So another important aspect is we need to look at how the similar startups being valued. Now, how to look at which are the comparable companies. So there may be like you can use these days, you can go and look at the chat GPT or maybe Perplexity or anybody like. But the question is like there are certain databases like Traction, maybe one, Pagebook is another, Owler is another. You can look at like what are the companies in this particular segment where we are, and what sort of investors have invested money into it. So this will help you in getting a glance like who are going to be my investors, what is the thesis of the investors, because every investor has a different thesis. Okay, suppose you talk to me, I being majorly into the deep tech companies. So most of my investors are deep tech. So my angel investor investment is majorly into the deep tech. So if suppose somebody who being from a D2C brand, he's approaching me thinking that I being an investor, that may not be very helpful or relevant. The reason being because at the end of the day, the deal what I being showcasing to my investors in my network, they are not being interested in that those deals. Okay, so we need to be clear. Don't just rush at your investors. Don't just keep on like pinging to the investors. What I would suggest, let the investor talk to you rather than you talk to the investors. So more important is like you just take care of your customer and the client. You chase the customer, not the investor. When you go and talk to the investor, you tell your story. You don't ask for money, I would say. Whenever you ask for the money, I have seen the people don't give the money. But when you tell your storyline that this is what I've been building, this is the impact that will be creating, that will be helpful. Maybe not in first go, maybe 2 or 3 meetings. Try to build a rapport with the investor, that will be very helpful. Okay. I will not. Certain things, because the time is limited, so let me frame something on the legal side as well. So a founder's guide to investment agreement, like a lot of the time, two friends meet together and they have the verbal communication and say, we start a company and you become the CEO, I become the CTO, and this is how the journey starts. Nobody talks about the role. Like what is the role that you will be playing? So everything starts with a 50-50. You take 50%, I take 50%, and that is how the game starts. But whether those things being written somewhere, what is the scope? What you been bringing on the table? That those things are not being written. So there is a very strong agreement that need to be, and that is called the founders agreement. And this founders agreement need to talk about what is the role and responsibility, what you will bring on the table, what is your work. Okay, and based upon that, the certain ratio need to be decided that this is the ratio, and based upon the work that we will bring in to the company. Okay, so there is a term called term sheet. Everybody wish to have a term sheet from the investor. And this term sheet is, I would say, a non-binding agreement, that the first document you get from the investor side, that is the term sheet, which talks about certain things which are binding, certain things which are not binding. So per se, I would say the term sheet is a non-binding document that outline the core terms and condition of the proposed investment in a company, and it's a blueprint of the future legally binding agreement like the shareholder agreement. So once everything goes through, I'd go with the due diligence, financial, legal, valuation, everything get fixed, then we enter into an agreement which is called the proper agreement, that is called shareholder agreement. But that is the finer print. But before that, there being a very first document, which is a term sheet, and it's at the stage of the detailed legal drafting, ensuring all parties are aligned on major point before incurring significant legal cost. And then binding elements, there are certain things which are binding, while primarily non-binding, crucial clauses still in the term sheet. There are few things which are still being binding, and these are confidentiality and exclusivity. Confidentiality means I because you are coming as an investor, I may have the patented technology or something I have discussed in detail with you. And you have to maintain that confidentiality. You cannot go and talk to somebody and say that, okay, this is the model that can be built, and you also can build this model, I will invest. So this guy is doing this thing. So that should not be the case. So there need to be a confidentiality and exclusivity, and these are generally enforceable, even though our term sheet is a non-binding document. Okay. Key transaction details. The foundational element define the structure and the scope of the investment, like the parties involved. What are the part of the term sheet? Who are the parties to it? Company, which is a company, that is a startup company. Investors, who are the investors? Name of the investor. Sometimes the key founders and the shareholders. That's these all things being mentioned. Now, investor these days, they don't generally invest into the pure play equity model. They say that, oh, I don't want equity, boss. I want something over and above the equity. So they want some sort of leeway, I would say, over and above the pure play equity. So they said, I want preferred shares with a certain preferential rights. And then they say it can be a safe note, it can be a convertible note. So these can be a different sort of instrument which can be placed by the investor in the term sheet, because these instruments generally have the power over and above the equity shareholders. Okay. Suppose if something goes bad, the company not able to perform, then what will happen? Then the investor will say, boss, don't touch anything of the company, because my first right is there on it. So the preference shareholders will have a different separate right, I would say, an additional right over and above the equity shareholder. Investment amount, what is the investment amount that will be infused? That is also being part of that we'll mention. Use of proceed. Now I am providing you money. I am providing you 5 CR money. Where you will be using it? It is not that you take the money and then you are siphoning it. You are using it for other purposes which are not meant for. So there's a broad allocation of how the investment will be deployed: product development, marketing, team, technology development, whatsoever. Okay. Closing time, the anticipated completion, and कितने time में transaction हम close कर देंगे, that should also need to be mentioned. Valuation and ownership structure. There is a concept called pre-money valuation. Whenever you talk to the investor, the valuation need to be a pre-money. So pre-money means like before infusion of the money. Post-money means money, pre-money plus money infused equals to the post-money. Then it talks about the price per share, like what is the quantum of the money that is coming, how many number of shares that will be issued. Another thing I would suggest, a lot of people have in mind, shareholder founder को अपने share transfer करना पड़ेगा investor को. It is not like that. There is always being an issuance of share that will take place. Maybe for certain advisory stake which the investor is taking, maybe you need to transfer, but for the money that is coming, there will be the issuance of shares that will happen. Okay. Another important aspect, like a lot of the time when you incorporate, when you're being at the incorporation point, people suggest you go with forming an LLP. Never form an LLP. Investor cannot invest money into an LLP because there is no shares, there are no number of shares, there is no share price in an LLP. So there's again being a question point. If suppose you want to run your business on your own, you run it, then LLPs are good. But if you suppose want to invest, take the investor money, issue the shares, then you cannot do an LLP. So it's better, don't waste your time. If you have formed the LLP, convert it into a company, that will be better. Otherwise, later on, entire things will happen, and then at the point of investment, it will fail. Okay. Then capitalization, cap table or cap table. Cap table is majorly talks about like what is the ownership, who are the stakeholders, who are the shareholders in the cap table, and so it provides a detail and gist of the people who being on the cap table. So this is another important aspect, I would say. Don't make your cap table too clumsy. Like a lot of people coming together, placing 2 lakh, 5 lakh, and 10 lakh rupees. And what is happening? There's a long list of the investors. And when the big investor comes, he don't prefer like very clumsy. So it's always better, suppose 4, 5, or 6 people they are investing, go with a syndicate side, I would suggest. Like make one syndicate and then you invest. That is a better way rather than placing 5 lakh rupees to 2 lakh rupees in the cap table. That will be harmful from the perspective of the bigger investor, I would say. Okay. Liquidation investor returns. It will talk about liquidation preferences, like what is the time of the exit, maybe 4 year, 5 year expected time, I would say. What is the instrument, CCPS or CCD or whatsoever. And this again, like a lot of the time, there's a confusion in the mind of the investor as well as the founder. They're not able to reach to the valuation. They say that boss, it's been too early. You saying 20 crores or 30 crores, what is right, what is wrong, nobody knows about it. Let travel together for some time and then decide like what is the value. Okay. Or let the next round of investment happens and then we will convert our CCDs into an equity share. So it is better like to go with a CCD structure, compulsory convertible debenture, when the valuation is not being known. So then you, at the point of conversion, the valuation will be decided and you can get a certain discount, maybe 20% discount from, because you invested early from the next round of investment. So whatever the valuation that being decided in the next round, you may get a 20% discount of the valuation. So it is a better way when you don't know the valuation. Don't play with the things which you don't know. So investor plays safe at a very early stage investment, says that CCD is a better instrument, or maybe the safe note is a better instrument, and then later on we'll convert into equity shares. At times, like a lot of negotiations that happen, and people say, investor talks about like, I don't want 2x return, I want 3x, 4x. That is the multiple preferences that they place upon it. So it's all being a negotiation part where they will. So don't try to sign. Don't be feel too early to sign any term sheet until unless you don't understand the terms of it, because it will be very harmful. You cannot then derogate from it, because once you sign it, maybe not binding, but still that will create a harsh relationship between the two. So I would suggest like talk to a person who being a legal expert, who can provide you, guide you, and suggest you what is the right way forward. Okay. Then conversion rights, preferred shares can convert into common shares. Often the investor's option based upon the time, based on the basis of the event happening. Maybe you're saying that, okay, next round I will get my, when the next investor coming, I will get my shares convert, CCDs converted into equity shares, or this way or that way. Governance and control provision. Then it talks about she talks about the board composition, like how many directors will be there, investor, founder, independent directors can be appointed, voting rights, a specific shareholder on, or there also may be a position like the investor, when he is investing big money, then he may appoint a director as well, who can be a watch, who can act as a watchdog for the investment that we made, like how the company is performing. Voting rights, specific shareholder on board, voting right power. Sometimes weighted voting rights, preferred shareholder may say my voting rights need to be more than the equity shareholders. So all those things need to be decided. Protective provisions, investor consent for, and so there may be certain thing which may be acting as a protection layer for the investor. Quorum requirement, minimum quorum that need to be there for the board meeting or the shareholder meeting, that need to be there. Anti-dilution protection, it talks about, like, suppose example, very practical example. Suppose you talk to the first investor and the first investor says, okay, I'm investing money at 10 CR valuation. Now you are not finding the investor at that valuation. Now suppose you say that, okay, the next investor is ready to invest at 8 CR valuation. Now the first investor is losing the money because he invested at 10 CR. So he will say, if you go on a down round, then there will be the anti-dilution protection clause that will become applicable. Then you need to provide me an additional shares, because I cannot go with that my dilution on that basis. So that is called the anti-dilution protection. Right of first refusal, again, the investor will say, boss, I relied on you I being the first person who have shown interest, invested my money. So at least whenever you are raising the money, you should ask me first. If I have further money, I can invest you further in you, maybe in the different round as well. Okay. So that is called the ROFR, right of first refusal, because the people thinks about if some company is going like a rocket and you invested early, then you get a preference to invest it again. And so that is, they want to build it, the investor want to build it, ROFR, right of first refusal. Tag along rights, these are the minority shareholders right. They are majority shareholder, they may be minority shareholder, so both have the different rights. So when I say minority shareholder right, it's a tag along right. If majority shareholder sells, minority shareholder can join the sale on the same terms. So they are saying, if majority is selling it, you should also provide a right to us as well. We are minority and we also want to sell it. So this is the tag along right. This is for the minority. Now talking from the different perspective, majority shareholder right, that is called drag along right. If the majority agrees to sell, a minority shareholder must also sell on the same terms. वो ये नहीं कह सकते कि ये नहीं सर आप बेच रहे हैं, I don't want to sell. तो दिस इज द राइट्स फॉर द मेजोरिटी एंड द माइनॉरिटी. इस पे बहुत डिबेट होता है, लॉट ऑफ डिस्कशंस हैपन. तो ये बहुत इंपॉर्टेंट पॉइंट्स हैं जिसको हमें कैटेगोरिकली देखना चाहिए. एक बहुत न्यू टर्म है फाउंडर्स वेस्टिंग. आई इन्वेस्टेड मनी इन यू, आपने 2 साल काम किया, यू आर नॉट फीलिंग गुड अबाउट अ कंपनी योरसेल्फ इन स्पाइट ऑफ बीइंग अ फाउंडर. आप कहते हो मैं एग्जिट ले लेता हूँ, मेरे को कैसे एग्जिट मिले? तो बॉस मैं तो इन्वेस्टर था, मैंने पैसा लगाया और आप कह रहे हो मैं एग्जिट ले लेता हूँ, विच इज नॉट राइट. तो देयर इज अ कॉन्सेप्ट कॉल्ड फाउंडर्स वेस्टिंग और रिवर्स वेस्टिंग, इन विच it is saying that your shares will be pledged, founder shares will be pledged for a certain period of time, maybe 3 years, 4 years, there will be lock-in period, and your shares will be released certain percentage by percentage basis over a period of time. So I say that, okay, maybe first year I will, you as a founder hold suppose 30% stake in the company or 40% or 50% stake in the company. First year we will release 15%. Second year we will again release 15%, so that you remain attached and stay with the company rather than thinking anything else. Okay. Exit and liquidity provision. So these are the exit points, like company goes for the IPO or the put option, call option, redemption right, sale right, lockup period. So these are, so when you invest into a company as an investor, then it is not like on the day one of the IPO that you say that I sell my entire stake. Suppose Alibaba came and invested into the Paytm. It is not like on day one of the IPO, because the entire stock market will crash if that happens. So there need to be the time period, lock-in period, that you cannot sell your entire stake over a certain period of time, even if the IPO comes. Okay. Binding clause, I already explained. Confidentiality, exclusive, no shop. It means that you are talking to me. I've been thinking, discussing in my lobby, and you are saying also talking to somebody else, maybe my competitor. So it should not be that way. Governing law, specifically the legal jurisdiction, is an important factor. If something goes wrong, what is the jurisdiction? Maybe that may be Uttar Pradesh. It may, what is the position where I can go to the court of law. So that again need to be defined. Cost, expenses, allocation of legal and due diligence fees. These are all the binding clauses. And non-binding clauses are investment structure, governance right, board seat, voting right. These all things are non-binding clauses in the term sheet. Navigating the term sheet, seek legal counsel, negotiate thoroughly, due diligence. So these are the important aspects of the term sheet, I would say, that need to be looked at. Don't rush in signing any document. You are running a company which you can create a havoc if something goes wrong, if you may sign it without knowing it. So please go through it, understand it. If not able to understand it, talk to a legal counsel and he will suggest you, guide you, and that is more relevant. So I would say one thing, before like jumping or deciding on your own, take help of people who are expert in that particular area. Okay. If suppose you are building something which is very noble, try to get a patent of it. Okay. If suppose you name your company, but you want that this name is not good enough, you can create a trademark of the different name, whatever you want to. There's a company called Jasper Infotech Private Limited, but the brand name is Snapdeal. So if you want something to be changed, that can be done. So there is a trademark that you can get it for the name that you wanted to, and you can promote that name as well, because nobody want look at like what is the company name behind it, XYZ Private Limited or whatsoever. Snapdeal is a Snapdeal, and that's what. So this is how the things are. So I'm not going further. I just stopping because I want to give time to you guys. Anything, any questions that you want to raise, ask, which may be hurting you or you want to understand. That is more. That will make more sense to it.
Absolutely, sir. Absolutely. Thank you. I think that was a indeed a very good session to understand this. These are very important points when we talk about valuation. So I think we have two questions out here. Let me read it out for you. And meanwhile, if you really want to turn on the mic, they can you can raise your hands. I'll allow you as well to turn on your mic as well. So okay, let me read out one question. What are the most common pitfalls founder face when negotiating term sheet with investor? How they can avoid them? I think this is most asked question because I have seen at times, a lot of founders get into that pitfall while negotiating term sheets, and they don't understand a lot of terms. And a bit of you also explained. But Manish, based on your experience, having working with startup, if you can share maybe three top pitfalls that startup founders get into, and they should avoid that getting into that route.
Okay, fine. So one is like uh, uh, the important aspect is like when you're talking about the term sheet. One is like they will say at times that I want certain advisory stake. Okay.
Okay.
Now, when they say advisory stake, because this is what has happened practically, that's why I've been telling it to everyone over here. They say that I want 1% as an, I will invest 5 crore rupees, that fine. But I want 1% stake of your company as an advisory stake beside
Mm,
my investment. And this is on a post money valuation basis. Okay. So if we have not read it thoroughly, we sign it immediately. It cannot be a post money. It need to be a pre-money basis. Okay? Because it's not like the investor, everybody has invested the money, and now you are saying that okay, I need 1% as a fixed post the infusion of the money. Okay? Because that
mm.
1% will also get dilute when there's a pre-money that will be there.
Yeah, yeah, that's
So,
true.
so this is a very thin line that been there that needed to be taken care of. Okay. Then the investor at times will suppose one investor who is a lead investor. The lead investor is invested and they have already provided you a term sheet. Now you are negotiating with the second investor who is not a
Mm,
lead investor. Neither he is bringing so much of the money. Suppose first investor invested 10 CR, the second investor is saying investing 2 CR. Now, when the second investor is demanding you, boss, I need an additional favor. I want these things, these things, these things. Then you should play very strongly on that as a
mm,
founder. You should say, boss, I cannot do anything over and above my lead investor. So if the lead
mm,
investor has entered into this, I cannot provide anything, not even a bit of it, over and above what the lead investor, because the lead investor, I need to take a consent from the lead investor, and the lead investor will reject it.
mm,
So try to place everything on the lead investor, that this is the terms you need. If you want to, then come. And if you cannot, I cannot do anything. Even if I wanted to, I cannot do anything because my lead investor is not ready on that terms. Okay.
mm.
So third, another is like let me think. There are various, but let me think the most important one. Uh,
I think we can talk about the third point would be where in term sheet there are certain points and clauses which startup should actually, can negotiate with the investor. Maybe, ta some kind of rights or some kind, which a startup founder should actually
Yes.
negotiate with the investor.
So that I already covered, but still I tell you that if they say that no, I want 2x multiplier, 3x multiplier, it cannot.
Mm,
Then you can say that no, boss, this is something what the realistic value will decide. I
yeah.
cannot commit on day one that 2x or 3x or whatsoever multiplier impact I cannot talk about. Then
Mm,
another is like if they say that suppose I'm making an investment in the format of the CCD and they are pushing it too hard to you and saying that boss, you need to convert in 1 year period.
mm,
Then you say that
right.
yes, how I can convert it. Let the investor come, second round of investment will come, and then only
Mm,
I able to convert it. Okay.
mm,
So they need to be so don't because everyone will be pushing you for the time period. They are slicing you on the time that was that clock is ticking. Then again, maybe at times the investor will say, "Boss, I need the MIS of your company every week." It cannot happen. You
absolutely.
you need to say that it may be like maybe in a 2 months time I will be able to share because because it's more like a paperwork then. Okay.
Yeah, yeah. That's true. That's true.
So
That's
there
true.
may be certain thing which may be harsh, and so we need to be clear enough that where we need to stop. There need to be a button with you where you need to stop. So it cannot be. Suppose you are on a treadmill. Suppose going at 6 and 7, that's fine, but I cannot go at 12. So
Absolutely.
so we need to stop at that point. So every like investment has a different story and a different set of things, and
Mm,
so we need to look into. Then one important point more: you need to talk to your investor, boss. There is an employee stock option that will come,
mm.
and you define your employee stock option, saying that maybe 5% of my paid up capital will be the employee stock option
And
because
is
if
it
you are
this
not
is during the deal or
doing the
post the deal?
doing the deal only when the term sheet
Mm,
you need to say when the SHA being signed,
mm,
because there will be an employee stock option which may be 4%, 5%, whatever you feel, because I cannot remunerate the good
mm.
people on the cash basis. I need to
Right.
give good talent and I need to provide them employee stock options, and that need to be the part of my cap table. Okay. So then because suppose you have not mentioned this, then the investor will say, boss, you are providing to your employees at 10 rupees face value. The per share value of the company today is 1 lakh or 5 lakh rupees, and you are
Mm,
providing at 10 rupees, which is not right. It is diluting our stake. So you need to be very clear of like, okay, this is the employee stock option. This is I will provide to my employees at a certain discount, and you need to give a consent on it. Okay.
okay.
These
So
are
my personal question follow with this question. Can a founder also put this stock option for the future employees also?
Yes, of course.
Because it
Yeah, very
is.
good question. So I would say
Mm,
then there this is called the pool. So there is a called the employee stock option pool. So this
mm,
pool being created. So pool I being saying 5% of the paid up capital. I just doing a number because most of the company generally follow 5%.
mm,
So it can be 5%, 7%, or 4%, whatsoever. So I am not saying that immediately I've been providing an employee stock option. Over a period of time, I've been providing. So there will
mm,
be the grant of the options that take place, then there will be the vesting schedule, and then there
mm.
will be the exercise of the options. Okay.
Okay.
So this is how the journey will be. That will be helpful for the founders to provide the options to the employee without like asking and going and taking a confirmation from the investor every time.
Got it. Got it. Thank you. So there's one more question from Aditya. He's saying that I think we already have covered this key difference between pre-money and post-money valuation. Sir, if you can briefly share again about this, what is the key difference
No,
between
no,
pre and post? I think
that's an important point. Yes, that's an
yes.
important point. So whenever you say that, what is the value of your company? Suppose if I ask you being a founder, what is the value of your company? You talk about the pre-money value. that without the money that you are infusing, what is my value? If I run my business as it is basis, the way I've been running it, then this is the pre-money. Now,
Mm,
suppose 10 CR is my pre-money, and you as an investor committing 2 CR into my company, that 2 CR is an investment amount. So 10 CR plus 2 CR equals to 12 CR, and 12 CR is a post money valuation. So from the investor perspective, what he need to look at, okay, what is the pre-money? If I infusing the money is a 2. Now suppose the next investor is coming. So for the next investor, 12 CR is a pre-money value. Okay. So first, for the first investor, 10 CR is a pre-money plus money infused equals to the post money. Now this post money will become the pre-money for the next set of investors who are coming
mm.
into. So this is how the journey keep on going it. Okay. So always talks about pre-money valuation and post money. The investor wants to look at like, अच्छा बाद में क्या होता है मेरा infusion के बाद
Right.
ठीक है. Okay.
Okay. Got it, sir. Got it. Thank you. I think anybody have a question can raise the hand or put in chat box. But I have a personal question that I've always been thinking when we were talking with startup. They often get confused with what kind of a instrument they should be choosing. A lot of instruments like say CCPS, CCD, all these terminologies. I don't want to get into deeply into this, but at least like we understand from you these instruments how they are different from each other, the core nature of these instruments, and at what time these should be used and should be taken by startup founder at what stage. If you can share some insights on
Okay.
this.
Okay. Okay. So let me start with the equity. Is a plain vanilla equity. So equity shareholders, I would say, they being the owners of the company, and the equity share means that this is your money. This is the net owned funds that the business has, and this is the money that you have infused into it, or you have created the money out of it because of your reserve and surplus or whatsoever. Okay, so this is pure play equity. Now when I say CCPS, CCPS means compulsory convertible preference shares. So it talks about two or three elements out of it. It says I would have the preferred right at the time of maybe liquidation. If something goes bad, I will be the first person who should get reward or return out of it. Okay, so that is, they want to safeguard themselves by placing it over and above you as a founder, over and above you, and saying that, boss, if anything goes wrong whatsoever, then the CCPS will help in helping me in or safeguarding me. So CCPS is under the law. If I talk about it, it is in the nature of the equity. CCPS is in the nature of the equity, because these are compulsorily convertible. These are not optionally convertible. These are compulsory convertible. One day or the other, it need to be converted. You cannot go and then say that there is a redemption that can happen. It cannot happen. Okay, need to be mandatorily converted. Then they talk about like CCPS. There may be certain dividend that can be, but general parlance, nobody in these days talks about dividend. Okay, and for the startup, this is for the older companies that they have dividend right and all these things. But that whenever the dividend will be distributed, I should get a preference dividend over and above the equity shareholders. That is not being much relevant. Then, so liquidation is one. Then it may be. Now take example another one. This is called CCD, compulsory convertible debenture. Now this compulsory convertible debenture is again that is converted into equity mandatorily. It cannot be like I will not convert. It is compulsory convertible debenture. So maybe or may not be that it carries a certain coupon. So coupon rate may be the interest rate, and maybe somebody says that in order to built it in the nature of a hybrid instrument, debt and equity, we say that 0.001 is a coupon, 0.001% as a coupon rate of it. But at the end of the day, it is converted into equity. So this instrument is majorly being used when the valuation is not clear, And so we want to safeguard ourselves, say, let the company thrive, let the company do, and then let least to some numbers need to become need to be there, the revenue need to be there, then we can decide what is the valuation. Okay, so that is a compulsory convertible debenture. Then there is an instrument called OCD, optionally convertible debenture. So optionally convertible debenture is a pure play debt, I would say, though it is optionally. But if I do the valuation, I will take OCD as per se a loan rather than an equity side, because it is not compulsorily convertible. It is optionally convertible. Then there's a concept called OCRPS, optionally convertible redeemable preference shares. Okay. So, and post that, there's a concept called pure play debenture. I say that it's a pure debt with a certain interest factor that I've been providing you as a loan. I don't want to get it converted into equity shares. You pay back the money along with the interest factor. Okay. So this is the pure play debt. So these are the certain classification of the instruments that have been there, like how it works, how it plays the role. And so once, suppose you say like another thing, like suppose you are bringing too much debt into the company at the early stage. Okay, it may not be viable because it is hurting your profitability line. So don't hurt your profitability line at an initial journey, because it will become the part of the one line item as an interest component. Okay. But suppose you're able to get or raise the money debt, maybe from the government side, maybe you talk to the certain like authorities, maybe the technical development board, they are providing you at 5% simple interest, suppose, then it's good to go, because it is not hurting too much, as well as you are not diluting your stake too much into at an early stage to the investors. So try to protect your equity as much as possible, because it will be helpful to you in your next round of raising the investment. Okay.
Got it, sir. Thank you for because this topic is such, you can spend another 1 hour
Yeah,
and
yeah, there have
discuss
been five,
a
four,
lot
five
of,
hours for
and
discussion.
definitely we will do one physical workshop out here in Amity Innovation Incubator Noida sooner, and we'll call, interesting startups to, understand deep about this topic, and we can take this on and on for hours. And any closing remarks, sir, before I wrap up this session as with the interest of
I
time?
would say like uh, think deep, think big, but at the same point of time, don't be in a rush to like just go with the numbers. There are things which is beyond numbers. Try to create a storyline which is so great that everybody wish to be the part of your story.
Great, sir. Thank you. Don't, as a closing note, so don't rush for the numbers. Create a big story. That's a take from this session. And thank you, sir. And in a closing remark, I would like to reiterate the crux of this session. As rightly said, Mr. Manish has provided in-depth understanding of startup valuation, introducing framework like Burkus method is something that I never knew. I'll definitely read about Burkus method, clarifying the distinction between value and valuation, and as well as a crucial role of a valuer in the process. He covered essential venture capital approaches for assessing startup stakes and valuation while emphasizing the significance of financial metrics like MRR, ARR, a lot of terms that we keep on listening at times. And in the last the session also highlight necessity of founder agreement to prevent future disputes, diversifying a key investment instrument like say CCPS, CCD, and OCD, as you rightly said, along with crucial term sheet components, including pre-money, post-money, and the anti-dilution clauses. There are a lot of clauses that been, we should be running, and we will share one template as well with the participants whosoever are here and have registered for that session. And thank you, sir, for joining and giving your valuable 1 hour time. This session is available on YouTube, and you can check out later on if you would wish to listen to Manish and his knowledge. Thank you, sir. Thank you
Thanks,
for
thanks,
joining,
Arun.
and
Thanks,
glad
thanks
to
for the
hear you, sir.
opportunity. Thank you. Thank you,
Thank you.
everyone.
Thank you, everyone. Thank you. Take care. Bye bye.